Today I'm going to show you exactly what term structure is when it comes to options trading. We will talk about the different ways that it can be shaped, we'll talk about how events such as earnings impact it, and of course how you can use this knowledge to trade smarter. So the term structure simply shows us how implied volatility shows up across different expirations, right? The options chain has two primary dimensions. It has the different strikes that can be traded and the different expirations that can be traded. For each strike and expiration, there's an implied volatility number, which basically talks to us about how the options are priced. And the term structure is what shows us how the implied volatility looks at different expirations. So you could imagine on the x-axis, we have the 30-day, 60-day, 90-day expirations. And then on the y-axis, we have the implied volatility number. And for each of these expirations, we will be able to see what implied volatility it's at. Now, this chart tells us a lot of information about the options market itself for any underlying, and that's what we're going to go over in this video. So in a normal low volatility environment, when you look at the term structure, it will typically look like it's sloping upwards, meaning that the close dated expirations have lower implied volatility than the longer day expirations. The reason for this is that volatility is mean reverting, meaning if it's low right now or below its average, it's likely to increase in the future towards that average or above that average to balance it out. And so if we think about it, if volatility is low right now, it's probably likely to stay low for a little bit. But if I were to ask you, what does volatility look like over the next year? Well, it's probably going to be a little higher than it is today. And that's why when you look at the term structure, the near dated options will have lower IV than the longer dated ones. Looking at S&P is a perfect example of this, where maybe the 30-day options will have a IV of 10%. And then if you go out to the 1-year options, maybe it's up at 13, 14, 15%. Now, what about if volatility is high right now? Well, if we're seeing really high realized volatility in the moment, the stocks are moving like crazy, maybe there's a market downturn or there's been some really big news that's come out for an underlying ticker, then what we will tend to see is that the near dated options will have really high implied volatility. And then as we go further out in time, the implied volatility will start to come down. Now, the reason we see this is because of another volatility characteristic called clustering. If volatility was high today, it's likely to be high tomorrow. The market is still repricing things are still moving a lot right now. And so it makes sense that in the short term, if we're seeing high volatility today, we will likely continue to see high volatility tomorrow. So maybe the 10-day options are priced at 50% implied volatility. The 30-day is priced at 40%. And then as you go further out, you go lower and lower all the way to the 1-year options, which are maybe back down near the average at 20% or whatever it is for that ticker. A good example of this would be a meme stock, right? If you look at GameStop during its peak sort of craziness, you would see that the short dated options were trading in the high hundreds of implied volatility. And then as you went out to the longer dated options, it came down to the low hundreds and so on. Now, those are the two shapes that you will typically see in the term structure, not accounting for things such as events. And that's actually what we're going to talk about now. Because once in a while, you'll be looking at the term structure and it will look relatively normal. And then you'll see this spike somewhere along it, right? It'll be like this, and then it'll go like this, and then it'll come back down. When you see a weird shape like that, what it usually means is that the market is implying some sort of event to happen in the future around where that spike is. Here's how it works, for example. Let's say a company has earnings that is 20 days from now. If you look at the term structure, the 10-day to expiration options don't see that earnings event, meaning there is no extra movement embedded into those options because of the volatility that would be driven by the release of this new information. However, the 30-day options are exposed to that news, meaning there needs to be a spike on the 30-day options compared to the 10-day to account for that increased potential movement caused by the earnings event. The 60-day options also see it, the 90-day options also see it, but obviously they have more time around them. So what we see is it's low and then it spikes up and then it comes down again because there's dilution on the 60 and 90-day compared to the 30-day, which has the most exposure to it. And you can actually separate event volatility from non-event volatility by doing some math. In the PA terminal, right, our platform, we actually do that for our members already. So you can plot two term structures. We can say, here's the normal term structure, and here's the term structure without events. So you can actually see how much premium is embedded into each expiration because of earnings. All right, so when it comes to term structure, we have to ask a serious question, which is this actually a practical thing to learn, or is this just some purely theoretical concept? And the truth is, it's not purely theoretical. This is a practical thing that you should understand and will directly impact the way you trade. When you combine the idea of term structure with a few of the other things we've covered, such as your option Greeks, you start to be able to use the term structure to determine what expiration you should be trading based on what you are trying to trade. For example, if you you are trying to trade the difference between implied volatility and realized volatility, then you want to be trading shorter days to expiration because we know that the shorter expirations have more gamma and theta exposure. On the flip side, if you want to be trading a change in the level of implied volatility, then you probably want to be trading those longer dated options since they have more vega exposure and less sensitivity to what happens in the short term. That probably sounded like a totally different language if you are not familiar with your options Greeks. So what I'll do is I'll link our ultimate guide to understanding option Greeks in the description of this video. If you did not understand what I just said, please click on that video and give it a watch. It will make things super clear for you. And then if you still have questions, of course, just leave a comment on this video. Happy to help. There are also major implications about understanding term structure when it comes to trading calendar spreads. I know a lot of people like to trade calendar spreads because it's a debit position and it still kind of has this short vol exposure. But what people often forget is that calendar spreads are literally the tool for taking a view on term structure. In fact, in PA, in Predicting Alpha, we have an entire strategy based around trading calendar spreads, which literally uses the steepness of the term structure as the signal about whether to be buying or selling calendar spreads. And then in all cases, you want to know if the expirations you're trading are exposed to an event like earnings. The term structure is the tool that would allow you to see this. So yeah, term structure is super valuable. This is just a brief introduction to how it works. If you liked it, please leave a comment, like the video, help out. The algo loves it, and I'll be there to answer any questions you have. And besides that, if you want to learn more about term structure, you can sign up for PA, go through our calendar spread masterclass. It's pretty technical, but also extremely useful. You'll find it very valuable, and you can get it on the free trial. And besides that, everyone, I'll see you in the next video. Happy trading.